Hello, good morning. Welcome to Core Finance. I'm Matt Brown. I'm joined by David Paul, who is the Managing Director of VectorVest, UK, I should say. How are you today, David?
Oh, great, Matt. Thanks for having me, sir.
Always a pleasure, David. Well, let's start off. Today we're going to be talking about something a little bit different, about one of your, would you say funds or strategies?
It's one of our trading strategies, Matt. Probably our most conservative trading strategy. It's called worry-free investing.
I like the sound of that.
And its objective is to put together a portfolio of shares that should appreciate with very, very little work, that you can manage in about 10 minutes a day at the very, very most. So it's based on our longest term market timing system. And on the chart, I've got the UK market since the start of 2016. And the red and the green triangles that you can see represent what we call confirmed calls, or our longest, most conservative market timing method. And at the moment, the confirmed call is up, so the market is okay. So every single day, VectorVest sorts and ranks all of the shares on the London market by value, safety of earnings, and the trend. And in our worry-free trading methodology, we actually sort the shares on the London stock market by relative safety, which is a measure of the safety and the predictability of the earnings. In worry-free investing, we want to be investing in those shares that have the safest history of making money over the last few years. Okay, and in the next slide, I've defined relative safety. It's a function of many, many things, but the main things are earnings consistency, the company size, a little bit of volatility, how long the company's been around for. Yes. Dividends, very important. A company that pays even a small dividend that's got a history of growing that dividend safely is a much better financial prospect. And then, of course, all the financial ratios, of which I put up debt to equity, which is the one I look at myself. Okay.
Very important.
So on a scale between 0 and 2, VectorVest ranks the earnings safety and the safety of the company. And in worry-free investing, we want to be investing in those companies with the highest relative safety measure. In the tests that I've done, I've looked at a portfolio of 10 of those shares with no more than 2 shares at any one sector of the marketplace, trying to spread myself across the marketplace.
Diversify.
Yes. The objectives I've put, I think, in the next slide. Sorry, how it works, first of all. When we get it confirmed up, one of those little green triangles on the chart, it's now safe to buy stocks. So we buy the 10 top RS stocks, relative safety stocks. As I say, 10 of them, spreading ourselves across the market, no more than 2 in any one sector. As the market moves up, there's a very small probability that one could get stopped out of one of those shares as the market is rising. Nevertheless, it could happen, and VectorVest calculates a stop loss every single day. If you're stopped out of one of your shares as the market is rising, then we run the sort again, and we replace with a share that we're not holding.
Understood.
So if the general market is moving up, we're always fully invested, 100% invested. Now, sooner or later, the market will turn and start to fall. Markets breathe in and they breathe out,
yes,
like any other entity. Now, there's a much higher probability that you're going to get stopped out of one of your high RS shares. In this case, if you're stopped out, you don't replace and you build a cash position.
Understood.
So if the market does sell off and you get stopped out of, let's say, 3 shares of the 10, you would now be 70% invested and 30% in cash. The high RS stocks are very resilient to a sell-off. In the last little sell-off we had, I wasn't stopped out of any of mine at all.
Well, that's great to hear. And that was the sell-off over the recent weeks?
Yes, that's correct, yeah. So that's the process. When the market is rising, always fully invested. And when the market, the general market is falling, if you get stopped out, then you build a cash position. In an event like 2007, 2008, you'd be fully in cash, 100% in cash.
And are you waiting for the stops to be hit, or at some point do you do a re-evaluation of these stocks?
Well, if you get stopped out, you would certainly run the high RS uni search again. If anything has changed, then you could certainly re-look at the shares that you've got. But in the main, it doesn't change that quickly, so there wouldn't be that much to do at all. I think you can keep it under control in 10 minutes a day quite easily.
Good to hear. Moving on, the objectives.
Well, the objectives, of course, are capital appreciation and dividends, and much easier to do in the US market, some income from selling covered calls. More difficult in the UK market, and even in the American market at the moment, the volatility is so low that it's very difficult to get some premium. Okay, so all options traders around the world are in fact crying in the lack of volatility. So those are the three objectives. In the UK, mainly we're looking at capital appreciation and dividends. I've tested this in the American market over 20 years. And over 20 years, 240 months, there was only 177 trades placed, of which 10 were still open. And along the way, we collected 544 dividend checks, which was $51,823 of dividend income from a portfolio that started with $100,000.
It's a fantastic return.
So I didn't, in fact, add the dividends into the next chart, which is purely capital appreciation. And this is the capital appreciation where we've turned $100,000 into about $700,000 along the way, and that is the equity curve. You can see the 2000 to 2003 bear market, which went flat, the global financial crisis where it pulled back a little bit, and the bull market that we've been in ever since. But if I'd added dividends into that, the performance would have been much, much better. So Matt, just assume that you spent the dividends on London Pride or something similar.
Use it as income as opposed to a drip or reinvestment plan.
Quite so.
Understood.
Now, I've also tested this in the UK since the start of 2009, and in the UK we've had a very, very similar performance along the way, where we've turned £50,000 in this case into about £200,000 along the way. Now, again, no dividends have been, in fact, added into that. The performance would be much better if we had added in the dividend. So it is a mechanical method of building wealth with very little trading that can be kept under control in about 10 minutes an evening. Now, we've gone through it very quickly. I'm running a seminar on worry-free investing in central London next Tuesday night, and if you go to vectorvest.co.uk, you can just sign up for that seminar. It's a free seminar, and I'll go through all the nuances of the technique in a great deal of detail.
Fantastic. And just finally, off air, you mentioned the charts that you brought along today with the performance, and visiting a few people in the city, and what was their response when they saw that fantastic performance? Well,
they just didn't believe it. They just didn't believe that it could be done, because the performance in the US is about 17% annualized, and the S&P 500 has gone up in the same period by 7% annualized. So it's a performance twice and more that of the S&P itself. And very, very few fund managers have in fact been able to beat the S&P. But to do it with a mechanical system with precious little thought in 10 minutes a day is something that everybody can do.
Fantastic. Well, great story. Thank you very much for joining us today, David Paul.
Matt, thank you.
And we'll see you hopefully in a couple of weeks.
I'll be here.